Oh. David? Good call. I had paused it when I first got in here. Good call. So 149 million. What is that? Uh, 8.7%, not bad. So that's an average of about, over the last 10 years, what, 8/10%, 9/10% of the last 10 years? That's not bad. Book value per share. $10.35. So 25.2. 25.2%. What does that mean? That, because I don't know if we've come across this before, what does that mean that book value per share is rising faster than the share count is rising in the same time period? Or what is that a sign of?
I'm not sure if they're diluting shareholders, but I'm not sure how the share count increased anyway, but I would say.
Yeah, just guess, because I don't think we've talked about this before.
Are they retaining the earning for the book value to increase? Or maybe that's one.
Sort of. It essentially means they're increasing the underlying value of the company faster than they're diluting shareholders.
Oh, okay.
Does that make sense?
Yeah, that's a good thing.
This is why I put both of these here. Is not only to see if they're diluting shareholders, but to see if book value is either rising faster, slower, same rate as they're either issuing or getting rid of shares or keeping shares the same, to see if book value per share, or because book value per share, remember, is kind of the very basic level of what the company's worth. So,
by the way, you haven't recorded the screen. Do you still want to record the screen?
It should be recording everything now.
Is it? Okay. Well, I don't see usually when you're recording, I see a record sign on my end, but I don't see anything.
Let me make sure. Here. Make sure. Yeah, it says pause recording or stop recording, so it must be recording everything now.
Oh, okay.
So yeah, no, that's important because we haven't talked about that before. At least I don't remember talking about this before with you. So that's a nice thing to kind of catch when you do this preliminary analysis worksheet. Okay. ROIC is 7.8% rounded up. So 6.2% rounded up. So they've been increasing their margins, correct?
Mm-hmm.
In the last several years. What do you remember what this being higher than this means automatically?
Leverage? I don't know.
Yeah, the company has debt.
Yeah. It's pretty poor return on equity.
It's a manufacturer, though. You kind of have to expect it. Manufacturer and developer.
Yeah.
So 6.6%. 1, 2, 3, 4, 5. So their return has been rising there, which you would expect since ROIC has been rising over time. Free cash flow to sales. Ooh, that's interesting. Why is that interesting to me as soon as I saw it?
Free flash card.
Do you remember?
So for every dollar worth of sale, 15.6 cents goes into free cash flow.
Yes, and what's the number I look for here that's considered to be a kind of a cash flow machine company?
You said more than 10%, if I remember.
5% on this one.
5%?
Yep.
Oh. Yeah, but that's because last year's been really high. I mean, on average, it's not going to be.
Well, the average is 10.8% actually over the last 5 years too.
Hmm.
Okay, so quick look here at the balance sheet. What's the first thing you notice on here?
The cash and short-term equivalent, it seems to be going down. So I think they're funding. They bought out an American subsidiary, and they sold off some the debt, and then they sold off a small stake in the what's it called? They started selling off shares in the Washington's Patterson, so it's acquisition.
Yeah. Percent. Trailing 12 short-term debt. .3%. That makes sense.
Oh yeah, because cash equivalent is. Yeah, that makes sense. Yeah. So that's just literally takes the cash and then you subtract the debt.
Yeah.
That's exactly what you're doing. All right. Okay.
Yep. And the only reason I do this, I make notes of this every time I do it, is because I want to know later on in the analysis if the company has a net cash position or a net debt position. Because obviously, if they have a net cash position, that gives them a stronger balance sheet. If they're in a net debt position, that gives them a weaker balance sheet.
Yeah, that makes sense.
All sorts of different tabs. Okay. Anything else catch your eye here that you want to talk about?
I'm trying to figure out where the hell they account for the equity stake in the other company. It should be the other long-term asset, that one there.
Yeah, this makes up almost 62% of their entire balance sheet.
Yeah, so that
that's where it is.
Yeah, got it.
Okay. Cash and cash equivalents. This may matter depending on how big of a portion of their brick and their manufacturing side of things, how much of a percentage of their business this takes up. 7.8.
They actually make more money from developing than manufacturing. But most people think the company called Brickwork. You think it make brick, right? It does, but it doesn't take. You look at the income statement. It actually constitute a lower percentage of the income. Quite interesting.
Okay, EV. Do you remember how to calculate that? Because I'm going to have you do it.
Oh, yeah, enterprise value. I have it written down somewhere. I can find it. Is it the one where it's like short-term plus long-term debt, take away?
Yes. So I'll make it working. Minus cash and debt. Most of the time you just kind of disregard these because most of the time companies don't have these. That's the actual calculation right there.
Okay.
So market cap is 25 or 2.5 billion. So in millions, it's like that, minus cash and cash equivalents. Again, want to make sure we have the most recent data over here. So 21 plus short-term and long-term debt. No short-term debt. Long-term debt is 324. I'm not going to do debt equivalents here because we'll have to dig into the balance sheet and we'll do that later. So preferred stock, minority interest. I don't see any preferred stock, minority interest. 0 plus 0 equals 2803. What does that mean that is bigger than its current market cap?
But one sign that it could be potentially overvalued.
Yes. Correct. So this company, if I remember right.
Which makes sense when you have that much debt on this.
Yeah. So we can't do the EV to EBIT calculation because they have a negative EBIT.
Have you had that happen before?
Yes.
So what would you write it as? Just not applicable?
Because EBIT is negative. Okay, free cash flow. 127. 27. So 22.1. What does that mean to me?
It looks like overvalued. I think you want something less than 15 on that.
8 or less on this.
8?
Yeah, that's what I look for.
Oh, like less than 8, right?
Yeah. And this hopefully illustrates why, because I'm not happy with the 4.5% return over the next year. Essentially, that's what this is showing right now. And this is actually negative. So based on these numbers, I would not continue my analysis of this company. But because you said this is an interesting company with a kind of different dynamic, I want to keep looking at it.
I think the whole premise of this company is it owns like 40% of the other company. That's I think the only value in this company.
Yeah. And that's where we will find.
It's in the news and report. Then they go to annual report in June.
That's weird. It's usually in the investors section. Okay. Blah, blah, blah. Don't care about this stuff. So on here, they're showing an EBIT of 279 million. If these are in millions, yes. So what happens? What do I do when this is the case? Morningstar's numbers and the annual reports numbers are different. What do I do?
Look at the annual report one.
Yes, because those are actually audited numbers. So let's go back over here. Change this information. Figured it'd be 10%, but just want to make sure what the decimal was. Actually, it's rounded up 10%. Oop, wrong one. 10. And this is 9.99.
So let's round it up. Round it up.
So what do I do when these numbers are so far off from each other?
They look. I don't think the EV/EBIT. I think you were looking for less than 15 or something like that.
I look for less than 8 on both of these.
On both of them.
Yep.
So these are two signs that they could be overvalued.
Yes.
All right.
So what would I do if, say, this was this number and this one was this number? What would I do here?
You would look into the company more?
Yes.
Right.
Yes, which we're going to do anyways. So.
Interesting. So I guess from an earning point of view, this company is a let now.
I would say more from a free cash flow perspective because it's reasonably close on the EBIT perspective to what I look for in the 8 or lower. But on the free cash flow, its free cash flow isn't keeping up to its operating profit. What could that mean? Do you have a guess on what that could mean?
They're not using capital intensive, maybe the business capital intensive. Maybe they're not. That's what I'm guessing.
Perfect. No, that's exactly what it is. They have to put a lot of capital expenditures back into the business.
Yeah, it's a brick. If you look at it in the report, they manufacture brick. Like that's actually what the business do, and they do like anything to do with brick. You know, the color bond stuff.
Is this what you're talking about right here?
Yeah, they do pretty cool stuff, but probably not the best from a free cash flow point of view. It's not going to be like a financial transaction company like Visa or some shit, you know what I'm saying?
Yeah.
But if you go down to the 42.7% stake in WHSP, that's now about 39.3%, and the market cap of that company is about 6.3 billion.
Okay, so we'll calculate that out. So is this company public, or is this one of their subsidiaries?
That's a subsidiary.
Okay. So they own 50. Do you know what this means? They essentially own 50% of this company that has assets of more than $1.5 billion. So they essentially own $750 million worth of assets related to this subsidiary.
Yeah, right. I'm not sure how that's accounted for on the balance sheet, though.
Yeah, and we'll look, because if it's their subsidiary, it depends. When it's a 50% owned situation, they can either consolidate it. To my understanding, they can either consolidate it or kind of break it out. Most people tend to kind of consolidate it. So we'll see what they do. So right now, so you said this is about 39.9%?
39.3.
39.3.
Last time I looked at the recent, if you go on the ASX website, it's
okay. So, and that's about a $6.3 billion.
Yeah. I'll have a quick, I'll double check. Yeah. Yeah, the market cap is 6.3 billion of the other business, SOL.
47, 2.48. Okay, so let's stop here because this is important. What does that mean? I'll write it out. Is it BKW or BWK?
Brickwork. The code?
Yeah, the ticker.
I think it's BKW. BKR, okay. I think. All right, let me check. And the stock code for WHSP is SOL, ASA. Do you want to be more specific?
Yes. Okay, so what does that mean to you, that those two little sentences I just wrote? What does that mean?
The market values BKW's subsidiary or the company they own as like at nothing. It doesn't value like it. That's what it looks like to me.
Yes, or another way to put it is they put zero value on the current operations of BKW, being the brickworks part and the development part. And
yeah, pretty much.
Essentially giving no value to that side of the business whatsoever.
Pretty much. That's what it looks like.
Another way to put it is you can buy BKW right now for $2.5 billion.
Mm-hmm.
And you get their operations, cash, and all of their assets from their own business operations for free. Does that make sense?
Yeah, that makes sense.
So this is the potentially massively undervalued situation. So
how do we go further?
Let's dig in. Okay, so when they break out, when a company has different business segments and they break out those business segments, you can essentially put a value on the building products segment because they give you the EBIT right here.
All right.
So you can do this a number of different ways depending on what you're looking for. What I would look for here is I would essentially just do a quick EBIT valuation of this.
8 times.
Yeah, EBIT? About 8 times EBIT. 8 times.
Be conservative.
Yeah, so I'd put a value on this side of the business of about 608 million AUD right now.
Okay. Building product performance. I think that's the brick performance.
Products. 18. That makes sense.
Yeah, that makes sense. They have quite a lot of segment. They go for the annual report. Man.
Okay. I'm just kind of scanning through this, see if I find anything of interest.
They probably have 5 or 6 segments, I think. There's probably development segment and another one. It's a couple.
Okay, so right here. So building products, property, investments. So this is going to be fun. So once you understand, this is kind of where I talked about before about once you understand the basics of investment and value investing, you can value any number of things. So not only can you value this, you can value this, you can value this.
The investment is the SOL. That's the dividend they receive from their holding.
Right here?
Yeah.
Okay.
That's the dividend they receive. Yeah. That's
so,
not actually, that's more like.
The only reason that.
Yeah.
But to my bigger point, you understand what I'm saying now? Does this kind of fully flesh out how you can value these individual segments for a company like this?
Yeah. So it's got building product and there's property. Is that the property development?
Yeah.
94 million.
Yeah, right here. Property performance. Yeah, and this consists primarily, okay. Yeah. So these property, BKW's property segment. What is it, 94? And normally I would kind of spread these out more, but I'm trying to go through these quickly so we can hit as much as possible.
Yeah. Time mode.
So 752 million AUD. Okay. So how would you value these? Would you value these any differently than the other things we just valued?
Well, they put an 8-time multiple on 123 million.
That's what you do?
Yeah.
Okay. Yep.
Which makes sense because you're going to put an 8-time multiple on the other businesses. Although I think it's worth significantly more.
Yeah.
Because that business is like a Warren Buffett. It's like a Berkshire Hathaway.
And 23. Okay, I'm going to put an extra note here. You know why I put that?
But it also includes like a small stake in a coal mining company as well, the investment segment.
Okay, we'll get to that. But do you know why I put this right here?
So you don't double dip it, double count it?
Yes. So if I'm looking at this, say, months later or years later, I know specifically that this was their portion. So I don't have to kind of guess on if it was only 39.3% of the dividend, if it was the full dividend, what it was. So I specifically know for my analysis when I'm doing this, let's say I was to write an article about this company. So I know specifically for my analysis what it's from, and also if I look back 6 months, a year, 2 years, 10 years later, whatever the case may be, exactly what this percentage here was.
there's an interesting article I'll send you.
Okay.
About this business. So what it is this company BKW owns 39.3% of SOL, and SOL owns like 44% of BKW. So it's like a cross shareholding, and then it's sort of like prevents like corporate raid and takeover. But then shareholders had tried to get this company, the other company SOL, into court to unlock the value. I think it was about half of $454 million worth of value that could be created if they merge.
Yeah.
Yes, but they didn't. That's funny.
That's interesting. So, adjust the. Do those two lines make sense?
Yeah.
Okay.
Are you double dipping here?
So, am I?
Well, you're adding all these different business segments. You've just added that, plus you're double counting the BKW.
But what are we counting here?
Well,
when we count EBIT, what are we counting?
You count the building segment and the property segment, right? And the investment segment, which adds up to 2, 3, 4, 8.
Yes. So what are we doing when we count EBIT though? What are we valuing only?
The earning.
The operations.
Yeah, but its investment segment is not really their operation.
Yeah, I know, but they get this value.
All right.
Because they still get paid that dividend, they still get to use that as cash flow. Correct?
That is true.
So what I would do here, and again, this is probably out of the norm for some people, for many value investors, what I would do is I would add the actual value of the market cap of the stake to this value, because to me, you're not double dipping. Because here you're just valuing the operations here, but here, this is the actual stock holding of the company. Does that make sense?
Mm-hmm.
So, plus 2. So I get a value. Does that make sense?
All right, so you subtracted it, yeah. Oh, you added both together. Yeah, got it. So so what you've done is you got the EV of the whole company, multiplied it by 8, right? And then you added, and they gave you a value for just the operation of the business. Then you added the BKW, the SOL stake.
Yes, correct.
Right. Okay, that makes sense.
Okay, I'm going to continue scanning through this.
So it's like 4, 8. So what's the market cap? 4, 8, 2. So something like 50% undervalued or something?
Hold on. So what are they doing here?
Oh, look at the highlight.
So let's see if those numbers add up that we added before. So I'm getting an EBIT of total EBIT of 293.5 million. They are saying their full EBIT here is 280 million. So there's a disconnect.
I'll take the conservative figure.
So what happens when I see something like this?
You double check it or take the conservative figure. I would probably double check it, but I'll probably.
So this is concerning. You don't see this very often, where they state a number, let's say over here, and they have a completely different number over here. You don't see this very often. So this concerns me. So.
Is that called the investment EBIT? They must have rigged that around.
Well, they usually will talk about it in here. And this is why holding companies and conglomerates are hard to value, because usually what I'm expecting to see in here is something along the lines of we eliminated whatever XYZ million, what is this? What is this, like 13 million in consolidated EBIT or in consolidated financial reports due to, how do they word it? Due to intercompany expenses and cost or something like that is how I'm expecting them to kind of word it.
Right.
If they don't word it like that, then there's a problem, obviously, because there's a big, I mean, it's not a huge difference, but it's a significant enough difference to be concerning.
So you got like 13 million worth of discrepancy. Where do you think it's from?
I'm guessing it's due to consolidation. They eliminated some expenses and cash flows and earnings due to consolidation expenses and stuff like that, is my guess. We'll see what they talk about when they come through or when we go through here.
I sent you an article. It pretty much talked about how other investors have been trying to get these two bloody companies to merge together.
Yeah.
Unlock value, but they don't want to merge together.
I'll take a look at that later. I want to get through these because now I'm interested even more. So impairment, coal.
Oh, that coal impairment. Oh, that's where there's discrepancy.
Right here?
Yeah.
Yeah. That doesn't cover the whole thing, though.
Doesn't it?
Covers more than the whole thing, actually.
Yeah, you're tax expense. I don't know.
Okay, here's something else interesting. Why is that interesting?
Interesting.
Go back.
They had to pay tax on the dividend, is that right?
No, the net tangible assets part.
Right. Oh, right.
Oops.
Oh, right. So if the share price right now is $16.40 and then the net tangible asset is 12.42, and the book value, you can work at the book value, right? It's about 1.5 times book value, trading at 1.5 times book value.
Yes. So total assets.
What's the share price of it?
So let's see. 2875 minus 804.
They probably use a shareholder.
So they have about $2.1 billion in net assets right now.
Where do you get that number from? Wasn't it? Oh, you just typed it by the share count.
No, total assets minus total liabilities.
Yeah.
So 2.1 billion in net in net assets. So compare that to their market cap.
I think it was about 2.5.
Yeah, about 2.48, 2.45, somewhere around there.
Something like that.
So they're selling just above their net asset value. Do you know why that's important?
is not undervalued. Well,
net asset value is one of the most conservative valuations you can do. So essentially, when you're doing net asset valuation, you're not counting the company's operations whatsoever. So you can essentially, to put it another way, you can buy this company's net assets and you're getting its operations for free.
Pretty much. Yes, market cap 2.46 billion.
Does that make sense?
Yeah. Interesting.
So once you get going through this more and more, you'll notice things like this that'll be like, ooh, as soon as you see them, they'll be super interesting to you. You don't see this very often. Okay. Dividend. Okay. So that's their structure. This is their building process. So they're in timber as well.
Oh, there's a structure. Oh, they do masonry.
Yeah, timber, masonry, roofing.
That's probably recession proof. Right there.
Depends on the housing. If they're in residential, if they're in a residential area and the housing market around the world crashes, this could be big trouble for this business segment, at least.
The property segment is probably the better segment. Would you agree?
It's definitely the more asset light, more profitable.
Yeah.
Okay. Aha. So where is the land that this company owns? Do you know?
It's mostly, I don't know a specific. I've had a look at some of the report, but they it's around. It's not in the major CBD, but it's like they own like the massive like distribution like land. They build distribution centers and shit. It's like talking hectares.
Yeah, no. Where at though? Like Sydney.
A lot of them are in New South Wales.
New South Wales.
All right. I don't know if it's specific. You'll probably have to go have a look at the website or something. But
that's fine.
So are you saying we could value the land holding?
Yes, we can.
The land price varies across New South Wales, but you're trying to get like just a general.
Yes. Gonna have to do a lot of converting here. So and when I do something like this, I always take the kind of low end.
Yeah, just be conservative.
Yeah. So what I'm going to do is base it off this land up here that looked like it was undeveloped, because I'm going to assume it's undeveloped.
It is probably undeveloped.
Okay. So what I'm going to do here is I'm going to take about 161,000. How in the world?
You divide that price by the 616 and you get like a price per square meter, and then you probably have to convert the hectare to make some square meter. That's why I would
rounding up. So 161,000 divided by 6.6. So 261. So $261.4 per square meter.
Oh, I found it, but it's an old 2015 one. I think I want to change it. So the land, the holding,
2015.
Like 2015.
Where does it say that?
So the land is what is it? It's spread across Australia, so it looks like they've got some in New Zealand as well. I don't know if that's sold by then, but So they have done something like 15% New South Wales, 15% Queensland, 15% Victoria, 15% Western Australia. Some in South Australia, some in Tasmania. It seems spread all over the bloody place. Is it in the annual report?
It might be.
Because I found it for the 2016 one. It's probably a dig. Maybe it's in the quarterly.
They would most likely be in here in the annual. So they're a big builder in Australia, it looks like.
So these are plants that they own?
Yeah.
That's pretty well the CapEx. Yeah.
I'm just scanning through all this because I want to find to see if they talk about the actual property in here.
Yeah, they do. Let's keep looking. I think I remember saying it. Well, I want to look at the previous year. Just there it is. I think the total value of asset held within the property trust at blah 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 was 1.527 billion.
Yeah. You see what I highlighted?
No, what do you highlight? All right. Wait.
Okay, so that is the value I'm going to use right there.
All right.
What you can do if they don't talk specifically about their significant property values or equipment values in their annual report, which oftentimes they don't, unless it's they own a lot of property, you can do what I was about to do. Go through this entire process of trying to find the value of the property or an estimated value of the property, which you can find significant hidden assets. I know I've talked about Dole before, where they had almost $1 billion in hidden assets that were on the balance sheet.
$357.
Quote operational land value. Okay. Okay, so go back up. So these are talking about just their different operations.
All right. What's it? But go up a bit. It goes property trust, lease value, and then the asset value. There seem to be two numbers up there.
Still further?
If you go back to the where you got the numbers 357, right? What?
Oh, that was down.
Down. Sorry, down. If you go down. It seems like they yeah, so it seems like can you see the property trust asset value and then the property trust lease property? There seems to be two segments within this property. Yeah. So one is to buy and sell, and one is to borrow. I mean, one is to rent. Isn't that two different?
So what I would do here is I would count this value, and where was the other value at? 370 million.
No, that's. Oh, right. Okay. So are we going to take the asset value? This is confusing. This is confusing, man.
Yes. So here, actually, this is probably a good place to stop because your head's probably spinning already, right?
Yeah.
So this is probably a good place to stop, and we can pick this up next week at this section because this is it's going to take a while to explain this section.
Can we just take a conservative figure?
You can, but I want to show you how to value this.
Right.
So when you come across this again, you can do it yourself.
Right.
Because honestly, you can find enormous hidden value here. Like I said, with my Dole situation years ago, I found almost $1 billion in hidden value that most other people didn't see. So I want to take my time on this.
Right.
Because this is going to be confusing, and I'm going to explain it as well as I can.
Mm-hmm.
So you can do it in the future and find potentially massive hidden undervaluations.
Mm-hmm.
So does that make sense?
Yep.
Okay. So everything else for the most part pretty much makes sense, though, correct?
Yep. Yep.
Until we got to that part. So you learned a lot?
Yep. Yep.
Awesome.
Let me do a rough summary for everyone who's watching.
Awesome. So I will post this video after I upload it later into the masterclass. I'll post this into the Facebook page. I'll actually post this video in the masterclass as well, probably in a special section, because it's a different way to value things. Especially the next video I'm going to post in the masterclass, because that's going to be not necessarily confusing, but it's going to be hard to go through. So I'm going to post these videos. This is awesome. This is an awesome case study. So great pick here.
So what's your thought? Like, this is 50%. Like, if you calculated the total asset value to be like almost 5 billion, and then they're trading at 2.5, roughly 50% undervalued right off the bat. But then your other metrics said, based on the cash flow or free cash flow kind of analysis, is overvalued. So at what point do we?
Well, as of right now, I'm going to keep evaluating this company just for learning purposes because it's awesome. And you don't see these kind of situations very often. But in terms of actually investing in the company, have to keep going through the financials because there could be some major red flags. There could be mismanagement. There could be other things that we may need to talk about. And you'll see this a lot with quote unquote confusing situations. Yeah. A lot of times they will be undervalued massively because people won't take the time to understand them, which can be great for people like us. But it also means that unless an activist investor gets involved,
But you've seen the history of this company. Activists try to get involved, try to get the two companies to merge, and they've all failed. So it's not going to unlock. The value's not going to unlock, is what I'm saying.
And that was what I was going to say next. Unless somebody comes in and helps unlock the value, it can stay undervalued forever.
Well, I guess the only value of this business, from my point of view, is just increasing dividend and franking.
Yeah, the dividend. If you're looking at this from a purely dividend, kind of a solid perspective, it's probably a good investment. If you're looking at this as a massively undervalued situation, which it looks like probably on the value, it's probably not going to ever work out unless the owners die or something and pass it on to somebody else who wants to sell or merge or whatever.
Right.
So, but again, we'll keep finding that out over next week. So,
all right, cool. Sounds
awesome good. Case study pick. I love it. I love these kind of situations because you don't see them very often. So
I haven't seen it. I've never seen it before.
You don't see it very often. So when I see stuff like this, I get excited because I love not only learning myself about this kind of different situations, but also teaching this kind of stuff because you can only teach so much, like in the masterclass, but there's also nuances on that kind of stuff like this, where what happens when you're evaluating a conglomerate or holding company and they own different assets, they own parts of other companies and stuff like that. So it's awesome.
All good. All good.
So, hope this was fun. Hope you learned a lot.
All good. Yeah. All good. I'll see you next week then.
Yes.
And hopefully more people show up.
Yeah, hopefully. Like I said, we'll keep doing it. And you'll keep learning faster than them.
But I'm going through the books. I've got my priority for this year is a bit different. I'm gonna cut down the Chinese. I'm still gonna be in China, but I need to finish reading the book from the masterclass, man. That 40 book that you recommend.
Here, because I know we've talked about this. You and I have talked about this quite a bit. Here's some perspective on how much I've learned already this year in the first 31 days of this year. Where's my document? I'm actually keeping track this year.
Okay.
Of everything I've learned from this year.
We're having a competition now, are we, Jason?
No. I'm not doing that, but I've
give you perspective
from people that I've actually dealt with that I learn faster than just about anybody else they've ever met. So this actually isn't it.
Let's have a look. How do you keep track? Do you just write down books you read or what?
No, I'm writing down this year. I'm writing down books I've read, courses I've taken, videos, long videos I've watched. Okay, and this, doesn't even include all the videos either. This isn't the updated list for some reason. I saved it just yesterday. Let's see. Okay, so here it is. So here's.
You gotta share screen.
Okay, yeah. Hold on, I'll reshare the screen after I finish writing this. So, no, I'm not doing this as a competition. I'm doing this to show you how much I'm able to learn and how fast I'm able to learn, because I've taken years to literally learn how to learn faster and better and more efficiently. So don't think you have to read all of these books in the masterclass fast, because this is all I've read just this year so far.
Wow.
So these are all books, these are all courses, and these are all video content that are hour plus long videos.
Oh wow! Just keep yourself.
So keep
yourself accountable.
4, 5, 6, 7, 8 books already, and these are 300 plus page books. These aren't short books. I've taken part of 4 courses already, including another like textbook style book right here, and watched several long videos. And this doesn't even count the short videos or the short articles I've watched. So don't think, and I know I've told you this before, but I kind of want to illustrate it to you. Don't think you have to read all of those books. Will it help you over time if you read all of them? Yes. But again, I've been told by pretty much everybody I've worked with that I'm able to learn faster than just about anybody they've ever met.
Cool. Awesome. Thanks for sharing.
Yeah. So I've never done this before. And right now, because I've always kind of guessed on how many books and stuff I've read, between 50 and 75, right now I'm on track to read, what is that? 8 times 12. I'm like doing in my head. I'm on track to read 96 books this year.
Whoa.
And that, again, doesn't count the courses or the video content.
So, you can get a massive advantage in life if you develop the habit of reading. I'm reading a blog about it. The best advantage in life is to read.
Yes. Well, essentially, you can learn from other people's mistakes that way.
Yeah.
Okay. So, so don't think you have to read all the books. Just go through the course as fast as you can, as efficiently as you can, and we'll keep doing these. And like I said, if you show up every week, and you're going to get way further ahead than the other guys. And again, I understand life comes up. It's just a fact, though, that the more time you take to learn, the faster you're going to learn. So.
Cool.
So, Yeah, as always, any questions? I'm going to add certifications at some point relatively soon. It's a matter of how fast me and my team can kind of set everything up, because we're trying to automate everything as well, not only for us and our perspective, but for your guys' perspective as well.
Right.
So it's just a matter of time before the certifications are up. I'm going to add quizzes to every single week of the course. We're going to break out. I've got, as of right now, 526 videos on the YouTube channel.
Mm-hmm.
Which this is one of the things I was learning about and kind of thinking about, strategizing about over the holiday break, was we have so much video content. I need to make more courses.
Right.
So we're going to
put them together, put the videos together.
Yeah, so we're going to break these kind of out into segments on capital allocation, investment flow, which is already out there, owner's earnings, valuations, mindset. I think there's actually, I'll let you see it. So as of right now, these are, once I get it open, the courses me and my team are going to build out once I can find it. Okay, so I'm gonna zoom this out and share my screen with you. I've not showed this even to my team.
Okay.
I don't want to scare them, to be honest with you.
That's all right. Don't share that. That's fine.
No, that's fine. I can share it if you want to see it.
Maybe edit this section out because it's quite sensitive stuff.
So owner's earnings, these are all going to be certifications, all going to be different courses. Insurance companies, investment flow, total enterprise value, financial statement analysis, competitive advantages, cash conversion, how to evaluate management.
$15 certification.
Yeah, so we're going to do all that, and yeah. So we've got big plans to not only enhance the experience for you guys, but also to get more clients in here. We're going to rework the entire kind of structure of how the course is built. Nothing will really change for you guys, other than you're going to get more certifications and stuff like that, and actual certifications you can actually put on a resume or CV or whatever.
Right. That's a big task.
Yeah. So yeah, we've
that's a big task.
We've got a lot of work to do. So luckily, most of these videos are created already because we've got so much video content. It's just a matter of kind of organizing them and literally building the courses, building the quizzes, building certifications, all that. So,
I'm thinking, like, if you save you time as well in the future, maybe if we get to the point where we can sort of do this on our own, we could run the course every week with the newer people. So it saves you time from having to do it over and over again.
Yeah, well, that's what we've talked about doing, is you guys would become certified trainers or whatever, and you'd go out and get your own clients, and you get a big chunk of the money or whatever that would come out of that. So that's still part of the plans. So,
okay. Cool.
But I realize I need to figure out how to get this to more people, because a lot of people can't afford $169 a month or $197 a month or $1,500 or whatever. So I need to figure out a way to get the courses at not necessarily a cheaper price point, but a lower price point.
Yeah.
Try to figure
don't give it away. Please don't give it away. Please don't do it for
free. No, that will never happen. This stuff is way too valuable of information. So
don't do it for free.
No, definitely won't. So, yeah, I'm going to post this video in the chat in the masterclass, and I'll leave it there for the masterclass.
Okay. All right.
I'll leave that, what you said, I should probably edit out that part. I'll leave that for masterclass students.
All right, cool.
He tries to kind of give you guys an idea of what's coming in the future.
Okay.
But does that sound awesome, interesting, bad, anything? Any comments?
No, it was good. It was good. Like, one-on-one's a different experience from having a group thing. I've noticed.
Yeah.
Very different.
Well, and again, I notice I realize life comes up, but I think people learn faster in these group settings as well. So I just want to get more people in here too, was a big kind of push behind that as well. So.
Yeah, like I prefer if there were more people. You sort of bounce ideas back and forth.
Yeah, I agree. I agree. Better learning
experience. Where's everyone? Where's Shafiq?
Shafiq actually messaged me yesterday for the first time in a while. He's in Saudi Arabia with his family right now.
Right.
Mateo, we didn't actually meet last week like we were supposed to, so I still don't know what he's up to.
From Mexico.
Yeah, Mitch is Mitch is still working a ton. Jeff is on sabbatical for still building his businesses. So for now, until we get more people in here, you and I.
Oh, good. And what about the guy that joined last week on the Owners Earning webinar? Did he end up just signing up?
No, he has not yet. So I sent him information, and so we'll see.
All right, cool. Oh.
So I could tell you really wanted him to sign up because you even brought it up. I wasn't even planning on bringing up anything about the courses, so but you brought it up, so I appreciate that.
It's easier for me to bring it up than you.
Yeah. Oh yeah. No, yeah, I appreciate that too. So, until next week, I guess you can review this video if you want.
Same time or?
Yeah, I'll try to coordinate about the same time. If not, I'll work around the other guys' schedules if they can join. I'll just let you know.
I'm happy to work around their schedule if you want.
Okay.
All right.
Yeah, if we can get more people in here, I'll kind of try to move it around. So.
Okay. Make sure you save the Word doc though. I don't have to go through again.
Oh yeah. Yep, exactly. All right, David.
All right, cool. Thanks a lot, Jason.
Of course. Thank you. Have a good night.
All right. You have a good one. Bye.
All right, talk soon.